Okay, ladies and gentlemen, time for another exciting episode of Stacking Adventures. Today's Sunday, April 18th, 2021. This is Season 5, Episode number 5, and the subject today is gold and inflation. So, here we have some silver and copper and some gold coins. And what we want to do is trying to figure out, what makes these prices go up and down, and just kind of come up with some kind of model of what the prices are. Here's like a gold Bitcoin, and I think Bitcoin's now like $60,000 or something for one Bitcoin, although these copper ones are only like 50 cents or something like that. But this is what we're going to try to look at today, is figure out what makes these metal prices change over time. So that's our subject is gold and inflation. So if you recall, the last episode, I came up with this two-factor explanatory model. And what I'm trying to do, the goal is to find a simple model, a mental model, so you can sort of get a feel for like why the prices did what they did. So I came up with this two-factor model. One factor is a long-term trend, and the second is the shorter-term fluctuations. And so the long-term trend was the general price level. I called it inflation, but really inflation is the rate of change of the price level. So inflation sort of drives the price level, but the actual, the model is based on the price level. And this is a slower effect. And the faster thing is the real interest rates. It was the shorter term fluctuations. Now there's other factors I didn't mention, which I'm not considering. And there's a bunch of supply and demand factors. There's also other macroeconomic factors. And I'll just show you some of these, but I'm not going to talk about these. So there's all these demands, like for jewelry, and for dentistry, and for industrial uses of gold. There's demand by ETFs, central banks. So these all drive the price, but these are kind of hard to understand in my opinion. There's also a lot of other macroeconomic factors, and these are a little bit easier to deal with because at least you can get time series from various government sources. But the general one is the general price level, which is the CPI or PCE is one of the indicators for that. And I am using that. There's also inflation, which is the rate of change in the price level. I'm not directly using inflation, I'm using the price level. There's the real interest rates, which is the treasury yields on the inflation-protected securities. There's also the money supply. They have these measures called M1, M2, M3. There's the strength of the dollar. The dollar index is the total economic output in terms of GDP. But I'm only looking at the general price level and the real interest rates in this discussion here. So last week I already talked about the second one, the shorter-term fluctuations due to real interest rates. So today I want to just investigate more into the long-term trend underlying the gold price, is the general price level. So remember I said this, it's all based on this theory. The theory is that gold is a store of value and over long periods of time. And that's sort of like the proposition we're making, that it's going to hold its value over long periods of time. Now what has been observed is that over centuries and millennia, that an ounce of gold bought a similar amount of real goods or services. And an example I'm going to use is the workers' salaries. So the observation seems to prove out the theory. But I'm going to show this here, to show the evidence. But then you say, well, why does the gold price go up if it holds its value? Well, the reason is when you price the gold in a local currency like dollars, the price increase rises with the general price level increases, which is mostly due to currency debasement. Over the last 100 years, the US dollar has lost like 99% of its value. And this is something that the government does intentionally. So they call this the money illusion, which means that the price level rises with monetary inflation. But you got to realize the gold is not getting more valuable. It's the currency is losing value. So I just want to show some evidence that the gold holds its value over a long period of time by comparing salaries in 1792 and 2021, which is 229 years, so over 2 centuries. So if I'm going to do this, it turns out that when they first defined the dollar, it was back in 1792. They had an act of Congress called the Coinage Act of 1792. So we could learn now from this, how much did workers earn in 1792? And we can tell you what it is in both dollars and in gold. And the reason we know this is because the Coinage Act specified the annual salary of mint workers in dollars. And also specified how much gold equaled $10. So they defined something called an eagle, which is $10, which is 247 4/8 grains of pure gold, which works out to be $10 is 0.515625 troy ounces of gold. So, and that works out to $19.39 for 1 troy ounce of gold. Well, here's the salaries. I'll show you the salaries in 1792. They gave the salaries for like the main workers at the mints, like the people who were at the higher positions. So, for instance, the first line here is the director of the mint. He made $2,000 per year in 1792, and that worked out to what was it, 1939 per troy ounce. That worked out to 103.145 troy ounces of gold. Now today, in 2021, gold's about $1,700 an ounce. I think I showed in the beginning there that it's like 1774, but we'll just round it to like $1,700. So today, that amount of gold, 103 ounces, is worth about $175,000 today. Now, I looked up the actual salary in 2021 of the director of the mint. And by the way, all these salaries of all these mint workers, it's all public information because they're government workers, so it has to be available to the public to know what they're paying these people. They actually make $188,931 is what the director of the mint makes in 2021. So that's pretty close to the value of the gold, $175,000. In fact, it's probably a little more than that now. The next line is the assayer and the chief coiner. They each made $1,500 in 1792. And their salary in gold was 77.354 troy ounces, which in 2021 works out to $131,502. Now, I couldn't find those exact job titles, but there was some called the division chief, who made $123,100 a year. So that's pretty close to the salary in gold in 1792. And the next line is the chief engraver and treasurer each made $1,200 a year, which works out to about 61 ounces of gold, which is in 2021, $105,000. And again, I couldn't find the exact job titles there, but they had some senior engineering positions that paid $102,559 per year. Very close. And finally, there was a clerk position. And you know what a clerk does? A clerk basically is an office worker who's he's a skilled worker. He keeps all the books. He does keeps all the records. Back in those days, they didn't have any calculators or computers, so they had to be very good at arithmetic and just very accurate, and kept all the records. And his salary was $500 per year, and in gold, that was 25.78 troy ounces of gold. Now, in 2021, that works out to be $43,826 per year. Now, the average salary of a worker at the mint is $40,996 to $54,939 in 2021. And that variation there has to do with the location. The government pays higher salaries where the cost of living is higher. So the $54,000 would be the San Francisco Mint, and the $40,996 was I think the Fort Knox location, where the cost of living was lower. But you can see the salary of the clerk in 1792 and 2021 dollars was $43,826 if he was paid the same amount of gold. It's right in the middle of that range there. So you can see it kind of works out. So I think this pretty much shows that the observation is over 2 centuries plus that the salary of a worker in the same job, now he's going to be doing a little different stuff because he used different tools, but his salary is about the same in the amount of gold he has. But the next question I have is, okay, so what about the CPI? CPI is supposed to measure the general price level. And it's called the Consumer Price Index. And it's often cited as the measure of the price level. And then you take the year-over-year change in CPI is what people call the inflation rate. Like all the news media, they'll say, inflation is running at 1.5% last year or something like that. So they use this number as the inflation rate, the rate of change of CPI, and CPI is the general price level. But my question is, did gold price actually keep pace with CPI? So what I did was I downloaded 2 time series from Fred, the CPI-U and the gold price. And I'll just show you. I actually plotted these things here, and I plotted all in one plot here. So it's a little complicated, this chart. I was going to do it in a separate charts, but I decided to just do it in one chart. First thing I plotted was CPI, and that's the blue line there. And CPI-U started, and this chart goes from April 1968 to March 2021. It's like 53 years. So I looked in April 1968, CPI-U was 34.4. And the very latest one in March 2021 was just released like a week ago. CPI-U is 264.79. And that works out to, let me see what that works out to. That's 7.65 times increase in CPI over 53 years, which is an annualized rate of 3.39% per year. So you can say that according to CPI, the inflation rate was 3.9% a year over the last 53 years. Now, next thing I did, I plotted the yellow line. The yellow line is gold, and is gold if it increased with inflation, which is what we're saying it should do. The trend line should be just increase with the general price level. So gold back in April 1968 was 37.86. Now, if it grew at the same rate as CPI, which is 3.93% per year, that would increase by 7.65 times, and the price of gold would be $289.65 in 2021, March. Now, of course, you know the price of gold fluctuates in the short term. We already covered that last week, where it changed with the real interest rates. But you would kind of expect that the price of gold would fluctuate around the trend line, which should be the general price level increase. But what I did was I plotted now the actual gold price, which is a thick red line there. And you can see the thick red line in the actual gold price is pretty far above the inflation-adjusted gold price from, if I just increase it with inflation from 1968. It's always far above that line. In fact, what I did was I added a trend line there. The thin red line is the trend line, it's exponential growth. And so it turns out that the actual gold price in March ended up at 1718.23. So that's actually an increase of 45 times. So I just made this chart here. So you can see in this chart here that the CPI-U increased by 7.65 times, whereas the actual gold price increased by 45.37 times. And the annualized rate for the gold price increase was 7.59%, which is actually 3.66% more higher than the CPI increased. So it's kind of the gold price was like far above the CPI increase. So, but then you can say, well, maybe just right now the gold price is higher, right? Because interest rates are very low. The real interest rate right now is 0. If real interest rates went back up like, to 0.5% or 1% or 1.5%, the gold price should come down. So I made another calculation here. So just assume it comes down to suppose it went down to $1,000. That'd be pretty low. It hasn't been $1,000 since, when was the last time it was 1,000? Looks like it was way back in 2009. It cost over $1,000, over 10 years ago. I kind of doubt it's going to ever get below 1,000, but it could. But if it did, if that was the actual trend line was to be to 1,000, that's still a 26 times increase, which is 6.39%, which is still 2.5% higher than the CPI. So what are we to make of this? Over a pretty long period of time, 53 years, that gold had, somewhere like 2.5% to 3.5% more increase in gold. Does that mean that gold actually had a positive return over the long term? Well, this is kind of, contradicts our theory back that we stated earlier. So the question is, does gold actually have a positive real return? Because over 53 years, it increased by 25 to 45 times the trend, compared to 8 times for the CPI. and it outpaced CPI by 2.5 to 3.5% per year. So apparently gold does have a positive real return, and a whole theory of gold being a store of value and either gaining or losing value, may not hold. But like I said, there's lots of evidence. Like for instance, I looked at the salaries over like 2 centuries. The gold hasn't changed very much. And there's lots more evidence I could show. So what I did was I tried to explain gold's positive real return over CPI. So I came up with 5 possibilities, and we'll just look at those now. The first one is gain of mass. Now the thing is, if you put a gold coin or a bar into a vault, the only way that gain mass is if new gold atoms actually were to deposit onto the gold from somewhere outside. And we know that this doesn't happen. There's no gold floating around in the air that could add onto the mass of the gold that's in on your gold bar. So this gain of mass is explaining the positive real return over CPI. We just kind of reject that outright. That's impossible. Second way to have a positive real return would be to have income. So for instance, if you were to if you're able to deposit gold, suppose there was a bank that let you deposit 100 ounces of gold, and then after 1 year they gave you back 100 ounces and 3 additional ounces. In other words, they paid you interest of 3%. Well, that would be a way for your gold to actually have a positive real return. But I'm not aware of any bank that does that. And in fact, everybody I know that has gold in their vault, it does not earn any interest or dividends or rents or royalties. It doesn't pay any of that stuff. So I'm going to have to reject the second one too. There's no income from gold to give it a positive real return over CPI. The third possibility is supply. And I'm thinking, well, maybe gold is just becoming more scarce. For example, maybe people are hoarding it and nobody's selling it. So if you want to buy gold, you just have to keep bidding up the price higher and higher. And in theory, it's possible for a cartel or someone to corner the market in a commodity. I know it was been tried in the past. Back in the 1970s, I think the Hunt brothers tried to corner the market on silver, but it only works for a short time. I think that the Hunt brothers actually failed. It turns out that if you want to corner the market on, you have to buy all the silver or all the gold. So whenever it comes on the market, you'd have to buy it. And it just costs you more and more money. And as the price goes up, you'd be paying more and more. Eventually, you would go bankrupt. You would run out of money. So you only could corner the market for a short time. So I'm going to, and not only that, there's no evidence that anyone's cornered the market on gold. I mean, you could go buy gold today, and it's available. It buys and sells. It transacts all the time. So I'm going to have to reject number 3. The fourth one is that there's more demand for gold now than there was. Now, I know in the past 53 years, from 1968 to 2020, the population of the world has increased by about 2 times. It went from like 3.5 billion to 7.79 billion in 2020. So, if there's more people and if there's a certain number of people want to buy gold, maybe there's more gold buyers out there. And also, I know if you look at, I have this chart here I'm going to show where the gold is, who demands gold. And you notice the big one there is the red chart, the red thing on the chart there. That's China, includes China, Hong Kong, and Taiwan. And the second biggest is India. And both those countries, like the culture there likes to own gold. And now we know back in 1968, and China was in the middle of the Cultural Revolution, and they were like just mired in poverty. There was everybody was poor there. In fact, they could hardly they were starving. They could even get food. So I doubt if anyone was buying gold in China in 1968. Whereas since then, since at least like the 1990s, they've come out of poverty. And if you look at the gold price here, the gold price was going down from like 1980 to 2000. Then it started rising after 2000, and it really took off in the 2000s. And that's about the time when China started doing a lot of exporting. They kind of started in the 1990s, and it took a while to get started. But by the 2000s, a lot of factories were being moved to China, and the people started moving out of poverty into the middle class and into even upper classes, even into the billionaire class. So that's a possibility that that the demand is increased from some of these countries that pull themselves out of poverty. And I think India has some similar things there. A lot of people pulled out of poverty in India. So I'm going to say number 4, the demand increase is plausible. And the 5th one here is not so much that it had a positive real return, but that it's just being measured wrong. And that is that the CPI failed to capture the actual inflation over the last 53 years. And this is a definite possibility. I would not rule this out. There's other evidence for this besides the gold price. And in fact, you would notice that the people who report the inflation, they have the means to understate it, and they also have a motive to understate inflation. That's pretty well known, because solely, entitlements all go up with inflation, so they would like it to be as low as possible. So that's the explanation I come up with. The demand possibly is increased, and the CPI is not measuring actual inflation. So that's what I'm thinking is affects the price of gold. So let me just summarize this presentation here. So as a store of value, I've got 5 bullet points. As a store of value in the long term, gold should neither gain or lose value. In other words, zero real return. And I see evidence for this, like in terms of like a lot of prices and wages over like hundreds of years. They pretty much seem to stay the same in the price in terms of gold, the amount of gold you have to pay somebody. So it seems like the long-term trend is for gold prices to just pace the general price level. And again, I'll just show you that chart here. To me, that the thin red line there is kind of the trend line. That's the long-term trend on the price of gold that we're following here. And but in the short term, the gold price fluctuates with many factors, and noticeably the real interest rates. And again, you can see that, it does fluctuate quite a bit. And it can stay above the trend line for like long periods of time, like even like 10 years, even 20 years. Seems like, it was above the trend line for quite a while, all the way until like the 1990s, let's say about 10 years. And, it does fluctuate quite a bit. Now, the thing is, over the last 50 plus years, gold has outpaced the CPI by several percent a year. And, again, you can see that easily on this chart. Anyone can go get this data and plot it. You'll see that, the trend line does not appear to be anywhere close to CPI. It seems to be far above what the CPI would lead you to believe. And it's about, it works out to about 2.5 to 3.5% per year above the CPI. And so this either is a positive real return, or they're just, CPI numbers are just not capturing actual inflation. I think it might be a combination of both of those. And there's some unexplained source, possibly increased demand from more people wanting to own gold, specifically in countries that came out of poverty. And but also that they might be underreporting the CPI, the actual inflation a little bit. So anyways, that's our presentation for today. And keep on stacking.